London's Camden Market is where some of the world's top fashion designers find ideas. Jean-Paul Gaultier, the French designer, has said that Camden, with its range of street fashions, inspires him. The market itself says that other designers such as Stella McCartney and Giorgio Armani have been seen rifling through the rails there. But it's not just clothing that has its fashions. So does business strategy. Take the fashion for conglomerates. During the 1960s and 70s, they were all the rage. Companies such as ITT of the US, which started in telecoms, were involved in a huge range of businesses, from Sheraton Hotels to Avis Car Rental to Wonder Bread.
But then the mood turned against conglomerates. Why, the argument went, should shareholders invest in a business with so many different activities when they could just as easily buy shares in individual businesses themselves? The parts of the conglomerate, so the argument went, were worth more than the whole. So conglomerates were out. The new fashion in corporate strategy was focus. Companies were told to stick to what they did best. Yet here we are, midway through the second decade of the 21st century, and guess what's back in fashion? That's right, conglomerates.
The most esteemed investor of our times, Warren Buffett, runs a conglomerate. His company, Berkshire Hathaway, has invested in bricks, ketchup, and executive jets. Then there is Alphabet, the recently announced holding company of Google, whose businesses and future businesses include not just internet search, but driverless cars, smart homes, and smart cities.
It's not just conglomerates. Other fashions in business have come and gone. There was re-engineering the corporation. This meant tearing up everything the company had built over decades and redesigning it from scratch. Thousands of workers and managers lost their jobs. Did companies improve as a result? Some did. Others lost valuable knowledge. We don't hear much about re-engineering anymore.
Outsourcing was once the rage. Companies opened factories abroad to cut costs. They asked other companies, often far away, to run their customer call centers. Much of that remains. But in the reshoring trend, some companies have brought these activities back home again. Whatever the corporate fashion, some companies manage to survive. They make that move from street trader to well-established, long-lasting business.
Here on London's Oxford Street are some of the world's best-known and longest-living retailers. John Lewis started on the street and now has hundreds of stores and Waitrose supermarkets. 151 years old, it is one of the world's most successful employee-owned businesses.
In 1884, Michael Marks began trading in a street market in Leeds with the slogan, "Don't ask the price, it's a penny." Marks & Spencer has had its ups and downs, but it is still here.
What do we know about these long-lived companies? They do follow fashion. John Lewis and Marks & Spencer sell fashion after all. They also make mistakes. Marks & Spencer made an ill-fated attempt to expand in the United States.
But the longest-lived companies tend to have an ethos. They have something that they stand for. Something that makes them different. In John Lewis's case, it's employee ownership and always offering the lowest prices, never being knowingly undersold. In the case of Marks & Spencer, it's selling to Middle Britain.
It's a battle from Camden Market to Oxford Street, just as it's a long journey from startup to centuries-old company. Fashions come and go, in clothing and in business. Those companies that can ride out those changes in fashion and keep their staff and customers happy are the ones that are likely to survive. Michael Skapinker, Financial Times, London.